Here's how to decide if you should pay off your mortgage early or just invest that money. Bottom line, in most cases, you must not pay off your loan early. But to explain why, let's first refresh your memory on how mortgages work. So every loan has two parts, principal and interest. Think of it like two big buckets. The first bucket is your principal, the initial amount you borrowed. If your house costs $400,000 and you put 20% down, then $320,000 is your principal. The second bucket is interest, and its size depends on your interest rate. For example, that $320,000 loan with a 30-year mortgage at 7% will cost you $450,000 in interest alone. But if you had a 5% interest rate instead, your total interest payments would drop to $300,000. What is important for us is that first, your mortgage ends whenever you pay off your principal. And second, during the first months and years, you'll pay much more toward interest. And only during the last years, you'll pay more toward principal. Now let me show the calculator I've made for this video. As you can see, in month 21, your interest payment is 6 times higher than principal. But if I scroll down to the end of the loan, you can see that now principal is much higher than interest. On the last month, your total principal payments equal what you originally borrowed, and you're done. Now imagine you make one big extra payment, plus you get a raise after 7 years and pay $1,000 extra each month. The critical thing here is that those extra money goes straight to principal, not interest. Your interest stays the same, but now you're paying $1,000 more toward principal each month. What does this mean? Well, you'll definitely pay off your loan faster, but it also means that your main savings come from interest payments you won't have to make. Right? So you'd still need to pay off that $320,000. But if you do it in 25 years instead of 30, you will save 5 years of interest. There is one small tiny issue. Remember how interest payments are much lower at the end of the loan? Well, it means that you can't save much. In this example, you only save 120 months worth of interest, about $72,000. That sounds decent until you subtract the extra money you spent and compare it to what you could have earned by investing instead. To be honest, I have yet to understand why I have net loss when making extra payments. Maybe because of the high interest rate. But anyway, even when we compare interest saved to investment gains, there's a clear winner.